Farmers across the country are making decisions right now that could change the entire grain market this year. Not because prices have collapsed, not because yields look bad, but because something underneath those decisions is starting to move, and it's happening at the worst possible time, just a week before planters start rolling. Energy, fuel costs are rising, fertilizer risk is creeping back into the conversation, and suddenly, the math behind what to plant isn't as clear as what it was a few weeks ago. So the real question right now is, are farmers about to quietly shift acreage before the market even realizes it? Because if that starts happening, prices won't wait to react. Welcome to Boots and Bushels, your daily look at the markets that feed America. Today we're breaking down why rising oil could start tightening farm margins again, how fertilizer risk is quietly building ahead of planting, what farmers are actually watching right now, and the weather setup that could either accelerate or delay everything. Because this market right now isn't reacting to what's already happened. It's reacting to what farmers are about to do next. Let's start with the grain markets. Corn is trading near 453, soybeans trading near 1214, Chicago wheat trading near 594, oats trading near 359, live cattle trading near $233.28, feeder cattle trading near $355.03, lean hogs are trading near 93.57, and crude oil trading near 94.50. Grains are holding together, not breaking, but not breaking out either. And that tells you exactly what kind of market we're in. A waiting market, waiting on acreage, waiting on weather, and now waiting on input pressure. Because crude oil pushing toward $95 changes behavior before it changes price. And behavior is what drives the next move. Right now the grain market isn't trading supply, it's trading potential supply. And that comes down to what farmers are deciding in real time. Across the Midwest and Plains, fertilizer decisions are being finalized. Seed is already purchased or locked in. Equipment is ready. But one thing that's still flexible, final acreage balance. What's pressuring that decision? Not price, cost. That's the shift. Corn versus soybeans isn't the full story. The real conversation right now is exposure versus flexibility. Corn is higher yield potential, higher input requirement, higher risk of cost rise. Soybeans, lower input load, lower upfront cost, more flexibility if margins tighten. Why this matters right now is because input costs don't need to spike to matter. They just need to become uncertain. And uncertainty changes behavior faster than price does. Not analyst estimates, they're watching farmer behavior, because once acreage decisions are made, the market adjusts fast. Cattle markets are still holding strength. That hasn't changed. Tight supply continues to support live cattle near $233 and feeders near $355. But strength doesn't mean safe. Because the cattle market is extremely sensitive to cost shifts, and right now, cost pressure is starting to build again. Where the pressure shows up, if energy continues higher, feed costs stay firm, transportation gets more expensive, operating costs rise. What that changes, not immediately, prices, but buying behavior. Feedlots don't panic, they adjust. And those adjustments slow momentum, cap rallies, and change placement decisions. Right now, cattle strength is built on tight supply, but if margins tighten, demand doesn't need to collapse. It just needs to soften. And that's where trends shift. Now for our first news story, energy is driving this market again. Everything else connects back to it. Crude oil is pushed toward $94 to $95, and it didn't grind there slowly, it moved fast. Fast moves in energy signal instability, and instability spreads. It's not immediate, it's sequential. First, oil rises. Second, diesel responds. Then fertilizer costs react, and farm margins tighten. We're between steps 1 and 2. That's the window. The key question is not, is oil high? But, does it stay high long enough to matter? Because if it does, everything downstream starts adjusting. Our second story, fertilizer risk is back on the radar. This is where the real pressure could build. What's different this time? Farmers remember the last spike. They're watching earlier. They're reacting faster. What's happening now? Supply chains not fully comfortable, imports vulnerable, and prices are starting to firm. The timing problem. This isn't happening in the off season, it's happening right before the planting season. And why that changes everything, because decisions are still being made, and fertilizer is one of the biggest variables in those decisions. If fertilizer moves, corn margins tighten, soybeans gain relative advantage, acreage balance shifts. Story number 3, global risk is back in the driver's seat. Markets are reconnecting with Marco forces. What's driving it? Geopolitical tension, shipping uncertainty, rising energy costs. And why it matters? Because agriculture is tied to global movement. If logistics tighten, export flow changes, freight costs increase, price relationships shift. Markets are no longer just trading weather and supply, they're trading risk. Story 4, biofuels are back in play. Higher oil always brings it back. What that means is ethanol demand strengthens, soy oil demand improves, renewable fuels gain attention, and for corn this creates a counterbalance. Input pressure is negative, demand support is positive. And why the markets feel stuck is because both forces are happening at the same time. Story number 5, farmer selling is controlling momentum. This is happening right now. What producers are doing is selling into strength, locking in margins, and managing risks. What that tells you is farmers are not chasing rallies, they're protecting positions. What that does to markets is slow upside, increases resistance, and keeps markets range bound. Now for some weather. Not the story yet, but it's coming. Weather hasn't taken control yet, but it's getting closer. The current setup is cold air still moving through, rapid warm-up behind it. Volatility is increasing, and the severe weather risk is, as this pattern evolves, strong storms are possible, large hail, damaging winds, and tornado risk. So what actually matters right now? Forget everything else. These are the drivers. Number 1, does oil stay elevated? Number 2, do fertilizer prices respond? Number 3, do farmers adjust acreage? And number 4, does weather cooperate or interfere? The core takeaway, this market is not reacting to what has happened. It's reacting to what might happen next. And that comes down to one thing, the cost of farming. Because price doesn't decide profit, cost does. And right now, cost is starting to move. Not confirmed, not locked in, but starting. Every year there's a moment where agriculture shifts, not loudly, not all at once, but quietly, through decisions. And we are in that moment right now, where energy is moving, costs are starting to adjust, and farmers are making decisions that will shape the markets months from now. If you want daily updates on the markets that feed America, subscribe to Boots and Bushels, because we'll keep tracking the pressure points that actually matter.